Good morning, good afternoon, and good evening. It's another Friday, March 29, 11:15 a.m. this time. This is Mark Yu,
And this is Wawi Santos.
and this is episode 105 of Mark Yu and Wawi Show. We have a little special guest today. I'm just gonna show her forehead. Uh,
Hello, Sophie.
so yeah, so finally we're back on the recording. We skipped last week. But yeah, just as disclosure, we're not registered financial planners. We just have, meanwhile, we have the same passion and interest in the investing in the stock market. So we try to look up stuff and review or recap what had happened for the previous 5 days. And this kind of help us with our financial approach as well. So hope you guys join us and subscribe. So off we go. So this is a latest article from Financial Times published yesterday. AI boom drives global stock markets to the best first quarter in 5 years. So this is definitely a very bullish sign. Bullish meaning, very positive sign for the stock market. The MSCI index of the world stocks rises 7.7%. This is the whole world of stocks. As U.S. economy offsets expectations of slower rate cuts. So the Federal Reserve here in the U.S., they're still expected to cut rates 3 times starting this summer, which initially, right, while before we came into this year, they were expecting 7 rate cuts, but they easily cut down the expectations to more than half, to 3. But still, the stock market loves it, and we're again in another all-time high. What are your thoughts on that? Wow.
I think with with the economy still pushing through, the U.S. is in a good position to support the you know the strong trajectory of the economy. There's still some supply chain issues that are hanging around that is of concern,
Mm,
but also we have to think about the sticky inflation, and I think that's why they had to do three this year because of the inflation being so sticky. But looks like today's report is showing a better CPI, which is in line with the Fed expectations,
the
which
PC.
is like I forgot, but it was like 2.8%, I believe, which
Mhm.
falls in line with what the Fed was expecting for the month of February.
Exactly, yes. The PC index just came out, and Jerome Powell, the Federal Reserve Chairman, is live right now. And as of 42 minutes ago, what he just said is, quote unquote, that's what we were expecting. And it's good to see something coming in line with expectations. So if the market were to be open today, Good Friday, I believe that the market would again rally further higher. Would you agree to that, Wawi?
Yeah, if it's open today, that would be good. So expectations should be bullish by Monday.
Yes, I think it met the expectations of the chairman. And he further said, it's not as low as most of the good readings we got in the second half of last year, but it's definitely more along the lines of we want to see. We don't see it as likely to be appropriate that we would begin to reduce interest rates until the FOMC or the market committee is confident that inflation is moving down to 2% on a sustained basis. More good inflation readings like the ones we were getting last year. So the PCE number that you just said, Huawei, is 2.8 in February as expected. So this is good news for those who are looking into further possible rate cuts. And speaking of which, if we're going to take a look at the CME Fed Watch tool, the probabilities of cuts on May 1st obviously is none. Federal Reserve is 95.8% according to experts. That's certain that there's not going to be no any changes. But in June 12, 61% thinks that the Federal Reserve would ease. Finally, we're going to see some cuts on June 12, 61%. And then July, 77% of people thinks that the Federal Reserve would further cut by 25 basis points. So that's as far as we would like to go at this point, because there's no telling, there's no guarantee. There's always a probability that the tide could turn. But right now, if the Federal Reserve sticks to this outlook, I think there won't be any sell-off or big dips in the stock market, which is good for long-term investors like us. So we also take a look at the sentiments of the stock market and where the money is going. So I think because today is a holiday, we weren't able to pull up the fund flows that we regularly get from Reuters, but luckily we were able to get some information from Bank of America's fund flow research, which is pretty good, that it summarizes fund flows since the start of this year. And we just actually ended the first quarter of the calendar year. So quite impressive that we're already through with the first quarter of this year. Whereas last year, we were all kind of like on our toes looking at the stock market, thinking that we're supposed to be in a recession by now, but not really. So for the sentiments from the AAII Sentiment Survey, as of 27th of March, a couple of days ago, bullish investors are back from 43%. They increased to 50%. Half of the people surveyed thinks the stock market would continue to go up. Bearish investors fall down a little bit from 27% to 22%. Quite a dip. Neutral investors have jumped the ship to being bullish from 29 to 27. So a lot of people jumping from bearish and neutral to the bullish camp. Wawi, what do you think?
The sentiment has been very cautious as of recent, and wise investors are still looking at earnings as an indicator to support the tailwind for such ideas of a bullish trend. So knowing that inflation is in line, and the big or large caps are doing well, especially the Mag 6, I would say it would be the earnings that the market will be looking for right now to determine how they're going to position themselves right now. But it's definitely in the bullish trend right now.
You could definitely tell. Day after day, we're seeing all-time highs after all-time highs. And like what we have mentioned in the group, it feels like it's the late 2021 again, when the stock market just kept going up and up and up. It was only until the Federal Reserve decided to start raising rates when the party stopped in the stock market. But before that, the market was hitting all-time highs after all-time highs because of all the, what do you call those checks that being sent to the homes of people who are being unemployed. But right now it's a different story. The Federal Reserve is expected to cut rates. So this, in my opinion, could further push the market way up there if you're optimistic as me. So I don't know. It depends on summer. It might be no, it's not might. It will be an interesting summer this year.
Yeah, definitely. And I see the unemployment claims remaining neutral, and the employment status being um, higher than normal to continue. So definitely should be a good summer unless there's a black swan. I just don't see anything on the horizon. Looks like the only thing is the war that's going on in the in the regions of Ukraine and in the Red Sea.
Yeah, I'm trying to look at the unemployment rate. Actually, the unemployment rate increased a little bit as of 3 weeks ago to 3.9%, where Wall Street was looking at 3.7%. So a little bit of increase there in unemployment. So that's one thing to keep an eye on. What if it hits 4%? Then definitely Federal Reserve would be thinking, oh man, we're doing a little bit more damage now. So that would further be again another reason for them to cut rates, which is the market loves to see. So this is what AAI has been doing. They're adding this week special question. So for this week, how would you describe the current state of the economy? And 43.6% of the surveyors answered good. And then 39% mix. And then look at this, 9% great. So a lot of bullishness, again, reflected in the survey. The fear and greed index, we are at greed. Oh, sorry. There you go, baby. Fear and greed index, we are at 71 points. And then compared to 1 week ago, we were at 67, which kind of reflects where we are at this point. A little bit more bullish at this point in time. And then what we're going to take a look at is the market breadth or the market momentum. Look at that, Wawi, 125-day versus S&P 500. We are at the furthest point since we started monitoring this back in, when we started the podcast 2 years ago. So a lot of bullishness being keyed in here, a lot of momentum. So stock price strength as well is still going up. So there are not only the magnificent 6, 7 Yardeni. We have a chart here that we're going to show in a little bit. Yardeni actually pointed out it's magnificent 8. So we're going to take a look at that in a little bit. The stock price strength, it's still going up, but we haven't hit that peak back in December of last year. So there's more volume if this market still decides to go even higher from here. There's still a little bit more support to get where we could get it from. Put and call options has been a little bit lower. Well, not a whole lot of people buying put options in this. The volatility looks like it's still down. Quite down a bit. 13 at this point compared to its 50-day moving average. So not a whole lot of selling that's happening in the market right now. If anything, I think people are buying still. So for the group performance for the past 5 days, wow, would you believe that? Wow, utilities is the number one. Utilities. And then
That
followed
looks
by
like a rotation to me.
a rotation.
Yeah, a cyclical rotation, a signal.
Right. Maybe taking off. Oh, look at that. The technology is the worst performing sector for the past 5 days. So people trying to get a little bit defensive at this point. Wawi, what do you think?
Well, yes, there is that cautious tone, but definitely, just looking at the 1 week performance, you're seeing utilities, energy, and basic materials being there, and then followed by healthcare. You can see that cautious tone with that healthcare surge for the week that we are seeing. But definitely a cyclical rotation, a change in business cycle is what we're seeing.
Also for the past 4 weeks, Wawi, look at that. 1 month. Energy is the number one. Basic
Yes.
materials and utilities. So I don't see people who are being FOMO at this point of time buying oil and buying utilities.
Yes.
So this must be some of those people who would like to increase their defensiveness in the portfolio and locking in some of their gains. But for the year to date, still, it's quite clear who the winner is. Technology, communication services, financials. In a year where the Federal Reserve are expected to cut rates, which should actually harm the bank's profitability, the banks are the third best performing sector this year. Even with that other bank falling down, what was it? NYCB, New York Community Bank. I mean,
Yeah, but that was the commercial real estate exposure that they had. What I think is pushing the financing sector up is the possibility of opening the real estate sector to the public and more buying and selling in the real estate sector. So we're looking at mortgage business for the banks.
Right. So financials are doing awesome, but real estate is the worst performing sector this year. So probably something
Mhm.
to do with commercial real estate, like what you said, Wawi. So the VIX, yeah, we just talked about it. It's flat for the past 5 days, 0%. Didn't Nothing had happened volatility wise. S&P is almost flat, 0.23%. That's unbelievable for the S&P. We've been hitting all-time highs after all-time highs for the past 5 days, but looks like at least, it's been relatively steady. It's not zooming out of this world or anything like that. It's relatively steady. But
Yeah, but if we remember what Tom Lee said
uh-huh.
uh, early this year, that the expectation of him was for the S&P 500 to be at 5250
Yeah.
close to the end of this year. So
Uh-huh.
it looks like they have priced in these Fed rate cuts and all these changes coming along, more than 6 months. Usually the market will price in like 6 months, but looks like they're pricing in the whole year. But anyway, the short gist of this is look forward to earning results by April. I think that would give us more of the possible trajectory of the market.
Yes, that's a good point. Earnings will definitely be a turning point if, you know, let's just say Nvidia starts missing earnings. That will be big because, a lot of momentum is on Nvidia and the AI world. So some
Yeah.
flows from Morningstar actually printed by MarketWatch. Let's see what they say. From my perspective, the soft landing outcome remains intact. ETF inflows indicate there's not a lot of appetite for defensive positioning, whereas industrials, a cyclical sector, tends to do well in a growing economy. Uh, oh, give me 1 second, Wawi. Sorry.
Okay. Anyway, just looking at what happened, the S&P 500 earnings grew at 10.1% pace in the last quarter of 2023, which is more than double the 4.7% expected advance. According to the LSEG, high interest rates will likely weigh on consumer and corporate spending, with analysts expecting a 5.1% earnings growth over the first quarter. Companies begin reporting results, as I said, expected at the second week of April. Anyway, again, in that same note, if earnings continue to surprise to the upside, the Fed will have a hard time justifying three rate cuts this year. This is according to Emily Rowland, co-chief of investment strategist at John Hancock Investment Management. But again, she said, if we see a leveling out of inflation, this economic reacceleration could turn into something more sustainable.
Right. I agree with that. Earnings will definitely play a role starting this next quarter, which is in a couple months. So going back to the some of the sentiment index. This one is being surveyed by the daily news sentiment index provided by the Federal Reserve Bank of San Francisco. 24 major US newspaper. Let's see the chart. Yep, we're very very bullish right now. We are at point 2, where we have seen that back in 2020, I believe, or at least when we started the bull market rally. So a lot of bullishness along the circulation around there. Another chart here from the Federal Reserve. Households, direct and indirect investments, total percentage exposure to the stock market. We are at 26.9%. So it's still quite a ways for those who are thinking that everybody already has bought in the stock market. Not really. There is still some upside. There is still some potential for people to get into. So it's never too late. But we're not saying to put all in at this point. We're also not saying telling you to sell all your stocks at this point. So this is finding another chart that we think that's worth necessary to share. This is the house sentiment. This is from Quiver Quantitative. So this is for the government officials. If they're bullish, I think the market should at least get a little bit more support. So right now you can tell House representatives are very bullish. Oh no, this is the S&P 500. Excuse me. Well, we're looking at the bar line, which is very tiny. I'm gonna zoom in for this. Yeah, it's hard to tell. Oh, now it's very little. You could tell, well, sentiment is actually a little bit negative. March 2024 for the House of Representatives. So
Oh,
that's an interesting find. That yeah, this is stock. This is based on stock trading on Congressional Knowledge Act that requires U.S. representatives to publicly file their financial transactions. So a little bit of a negative side for the politicians. So this is the Wall Street Bets Fear and Greed Index, which we're gonna try to add in each and every of our episodes. So you can tell a lot of greed right now. A lot of greed for 2024 March. And index is on 75.6, which is bullish. So now, before we run out of time, we're gonna go to Wawi's take. So Wawi, what do you have for us this week?
well, I have AMPX, which just came to my radar a couple of days ago, I think. They have this silicone anode for all kinds of equipment, including cars, phones, Internet of Things. There's a big buzz about it. It seems like a good technology and uses less power
Wow.
to uh, use. And it was
It's like a
uh,
semiconductor company.
it was looked at by Monroe, who is an engineer that looks at different types of batteries, and he was very optimistic about the technology offered by AMPX.
Mhm. So according to this Seeking Alpha page, AMPX, Amprius Technologies, $2.65. It's badly performing so far this year. It's down nearly 50%, and it's down a further 60% for the past 12 months. Market cap is very tiny, 235 million, not tiny in terms of value, value, but usually we take a look at really large companies, trillion-dollar companies. So this is a small cap for sure. So let's look at his financials. So 2020, let's see. Okay. It nearly doubled or more than doubled its revenue since 2020, 4.7 to 9 million in 2023. However, their cost of business is a lot more, 23.7 million. So definitely they're investing a lot or spending a lot in their salaries and look at that. They spent 20 million in their salaries and spending 4 million in research and development. So for me, honestly, it's a little bit of a negative indication because you're spending a lot more on your employees than what you're researching about, ending to a nearly $40 million loss. Let's take a look at this balance sheet. Maybe it has a good cash situation. That's why it's confident in spending a lot. Yeah, it does have 46 million in cash. And let's take a look at its debt. It has 35.6 million in debt. So about 10 million buffer, but they're losing cash pretty good. on an annual basis. So it's quite a little bit worrisome. So we're just gonna take a look at its valuation. Obviously, it won't have any price to earnings for this year because for last year as well, because it doesn't have any, it didn't generate any earnings. So it's quite difficult to value it except for the price to book. It's 1.4 times, whereas its peers, competitors are at 2.7 times price to book. So it's a little bit less pricey. Let's look at its peers before we move on. So closest peers are Fryer Battery, EOS Energy, Wallbox. So they're kind of in the same market value range, $250 million. And in terms of performance, man, all of these guys, Wawi, are down, except for Ulbi. Who's Ulbi? Ultralife Corporation. It more than doubled this year. But oh, not double this year, but 30% up this year. But so far this year, AMPX is down 50%. Fry Battery is down 10%. EOSE Energy, it's down 5%. WBX Wallbox is down 20%. So quite a dire in a world where we're seeing all-time highs after all-time highs. These companies are being neglected, looks like. But interesting pick, Wally. A small cap, definitely. And what's your
Yeah,
other?
yeah,
Sorry.
definitely. For those that are listening, probably needing some deeper dive into actual capex. Like, are they really building that factory? Are they really partnering with this Brazilian company? To grow their technology. But definitely a lot of interest right now because it's a new anode that is very promising for its capabilities, silicon anode technology.
Yep. Looking at its capex that what you just mentioned, Wally, it definitely jumped from 1.5 million in 2022. It jumped 18 times to $17.6 million. So, yep, they're definitely putting a lot of money on that factory. So, next one, what's your next pick, Wally?
Okay, well, this is my son's favorite place to eat when he was in college, so that would be Chipotle. Okay, it's about to do the 50 the 1-50 split. So there's a lot of excitement right now for this company, and they're doing some innovative technologies in their production line. Like this avocado that would slice up these avocados for their uh, food service, and looks like they're putting technology into their uh, production line and service line. So in some interesting stuff, and they're trying to double their footprint
Mhm.
by 2030, I believe. Up to 7,000 stores, and they're trying to branch out into outside the U.S. like Middle East and I forgot where else, but Canada, yeah, Canada. So, and that's what brought my interest to this seemingly growth directed restaurant business.
Yeah, not a bad pick at all. Chipotle's been really rising up its share price in recent years. 50 to 1 stock split would give it a value per share of $58 once it's done. So nothing of fundamental will happen, but the stock price would be a little bit cheap in terms of face value. It's partially psychological, according to Howard Silverbat, S&P 500, S&P Dow Jones Indices index analyst. So a lot more people will be able to buy the stock of Chipotle if that happens, compared to a $3,000 a share price at this point. So let's take a look at his market cap a little bit, diving into their numbers. 79.7 billion in market cap. That makes me wonder at what value is McDonald's at this point? 200 to $3 billion. So if this guy keeps what do you call this, expanding, there is still more room to go. Compared to Starbucks, let's say 103 billion. So it's, yeah, it's a little bit acceptable that there's more upside to come in Chipotle. It's 79.7 billion. We're gonna take a look at his peers in a little bit, but yeah, forward, let's take a look at his financials. Yep, like what we said, this company is growing by the billions. From 2019, 5.5 billion. It also grew during the pandemic, 5.9 billion, and now it's looking at breaching $10 billion mark. So December, 9.8 billion, and its profitability, which is awesome because it's more than quadrupled its profitability from 350 million to 1.2 billion dollars as of last year. So the company knows what it's doing at this point. Financials, let's see about their cash. They have about 1.3 billion in cash and about 4 billion in debt. So a little bit more debt than cash, but I won't be surprised that they won't get any good debt if they need to, or financing, but because they generate cash pretty well. They're very profitable. Cash flow. Yeah, let's take a look at its free cash flow here. Levered free cash flow. Yeah, they're pretty solid. Almost $1 billion in free cash flow as of December of last year. So not a bad pick, Wawi. This is a good, very stable company, looks like. But look at the price to earnings, 55 times compared to the median of 17 times. So they're very pricey at this point. Price to book 26 times compared to 2.2 times their peers. But let's take a closer look. Who are the peers? Meituan, Starbucks, which we just pulled up earlier, DoorDash. I think the better comparison would be Starbucks and Yum Brands. And if we can add, I don't know how to add, maybe Shake Shack into the mix, because I'm seeing Shake Shack too, like expanding. But yeah, so let's see for this year. Oh, I'm not seeing. Okay, Chipotle is up 27% already this year. It's the best performing stock among its peers compared to Starbucks, which is down 4.8%. And Yum Brands is up 6%. So, bit of a good catch here. Wow, very solid financials, but a little bit pricey in valuation perspective.
So I would think all depends on their execution. They have a target 6 years away from now, so that's a long timeline to double their stores. There is a lot of demand for healthier um, food for the public. So I look at CMG as a provider of these healthy food trend, and the ability of the customer to pick what they put in their burrito and choose what ingredients they want in there shows the flexibility of their market. So
Yeah.
we'll see. Definitely, but looking at the 10-year, but having the caveat that not all high performing companies, will have a linear trajectory, but that 454% growth in 10 years is really impressive. And looking at the stores that are coming out, looks like they might be able to do it.
Mhm. Yeah, that's a good point because the one thing that would really kind of like hit them hard is when they overexpand and consumers starting to go away from their brand. Because I'm thinking of somewhere along the lines of a Subway, or how the downfall of Subway has played into, into its dire straits in recent times because of their overexpansion. So I think they should learn from that and they should apply it. Well, yeah, we got less than 2 minutes to go, and we're just gonna breeze through the last remaining data that we have. So this was published a week ago. The U.S. leading economic index, it actually turned a little bit up, and it is the first time that we have seen an inflection in February 2024. This is the first time since February 2022. What does this mean? It just means that we are seeing some positivity in consumer expectations in terms of manufacturing and stock prices, strength in weekly hours as well. So a little bit of positivity in terms of the indicator here. And as promised, let's take a look at the fund flows from Bank of America. So for the first quarter, the tail of the tape, the fund inflows winners are cash. $231 billion missed the rally so far, the 30% rally from the S&P 500. IG bonds, 119 billion. US stocks, 75 billion in inflows. Emerging markets saw 53 billion. Losers, outflows. Believe it or not a whole lot of people are buying gold. 6 billion outflow. It's only the government are buying gold at this point. Energy also, the best performing sector for the past month, is the worst performing fund flow in the last 3 months, $8 billion. Emerging market debt, negative 8 billion. Europe, a lot of people selling Europe so far this year, the first quarter. There's another highlight. Weekly. So for the weekly flows, 16 billion flown into stocks, 15 billion into bonds, 0.3 billion to crypto, 300 million, 0.2 or 200 million going to flown out from gold, and then 23 billion flown out from cash. So a lot of money moving into stocks this week, according to Bank of America. And Japanese equities are seeing a lot of inflows, the largest since 2021. A lot of FOMO in Japanese stocks. So I think we're going to be disconnecting a little bit. Thank you guys again for staying with us. Again, this is Mark Q.
Thank you, Mark.
Until next week, thank you so much, Wawi.
And thank you, baby Sophie.